Hi, welcome to Educator. This is Teacher Jeff. I'm an educator and an engineer by profession. And today we will discuss Chapter 5. And Chapter 5 is all about accounting for the sale of goods. And in today's lesson, there are five key areas that I'm going to be highlighting today. First, we have the basics of merchandising. Second, we have the purchase and payment of merchandise inventory, perpetual. Third, we have merchandise inventory, sales and collection using perpetual method. Fourth, we have adjustments to merchandise inventory applying the perpetual method. And finally, we have merchandising income statement. And in order for us to get started, let us discuss the first key area of our lesson, and that would be the basics of merchandising. Now, to this point, examples of business operations have involved the sale of services, right? Now, this chapter introduces business operations based on the purchase and resale of goods. For example, Canadian Tire and Walmart each purchase and resell goods. Such businesses are known as merchandisers. Now, the accounting transactions for merchandising companies differ from those of service-based businesses. Now, Chapter 5 covers accounting for transactions of sales of goods on credit and related cash collections by merchandising firms and transactions involving purchases and payments for goods sold in the normal course of business activities. Now, here in the basics of merchandising, take note that a merchandising company or merchandiser differs in several basic ways from a company that provides services. First, a merchandiser purchases and then sells goods, whereas a service company sells services. For example, a car dealership is a merchandiser that sells cars, while an airline is a service company that sells air travel. And because merchandising involves the purchase and then the resale of goods, an expense called cost of goods sold results. So, what do we mean by cost of goods sold then? If we say cost of goods sold, it is the cost of the actual goods sold. For example, the cost of goods sold for a car dealership would be the cost of the cars purchased from manufacturers and then resold to customers. Take note that a service company does not have an expense called cost of goods sold, right? Now, why is that? Because in the first place, it does not sell goods. Because a merchandiser has cost of goods sold expense and a service business does not, then the income statement for a merchandiser includes different details. Now, a merchandising income statement highlights cost of goods sold by showing the difference between sales revenue and cost of goods sold, called gross profit or gross margin. Now, the basic income statement differences between a service business and a merchandiser are illustrated in figure 5.1. Now, as you can see in figure 5.1, it illustrates the difference between the income statement of service and the income statement of merchandising companies. Now, as you can see on our example, in my left side, you have there a sample income statement of a service company. So as you can notice, you only have revenues less expenses, and the result would be the net income. On the other hand, in my right side, you can see there the merchandising company. Now, this is an example of an income statement of a merchandising company. So instead of starting with revenues, you should be starting your income statement with sales, okay? And these sales should be deducted by the cost of goods sold. And the result of that would be your gross profit. And then this gross profit should be deducted by the expenses. And the result would be the net income. So these are the differences between a service company and a merchandising company's income statement. Now, in order for us to better understand this, let me give you another example. Now, assuming that Excel Cars Corporation decides to go into the business of buying used vehicles from a supplier and reselling these to customers. Now, if Excel purchases a vehicle for $3,000 and then sells it for $4,000, then the gross profit would be $1,000. So you can see there sales. Okay, so your sales is $4,000 minus the cost of goods sold, which is $3,000, and your gross profit is $1,000. Now, the word gross is used by accountants to indicate that other expenses incurred in the running of the business must still be deducted from this amount before net income is calculated. So in other words, gross profit represents the amount of sales revenue that remains to pay expenses after the cost of goods sold is deducted. So what do we mean by gross profit percentage then? So if we say gross profit percentage, it can be calculated to express the relationship of gross profit to sales. For example, the sale of vehicle that costs $3,000 results in a 25% gross profit percentage. And this is calculated as gross profit percentage equals $1,000 all over $4,000 equals $0.25 or 25 cents. Or if it is expressed in percentage, so that would be 25%. So what does it imply then? Well, it implies that for every $1 of sales, the company has $0.25 or 25 cents left to cover other expenses after deducting cost of goods sold. Now, readers of financial statements use this percentage as a means to evaluate the performance of one company against other companies in the same industry or in the same company from year to year. Now, small fluctuations in the gross profit percentage can have significant effects on the financial performance of a company because the amount of sales and cost of goods sold are often very large in comparison to other income statement items. Now, aside from income statement, another difference between a service company and a merchandiser relates to the balance sheet. So a merchandiser purchases goods for resale, and these goods being purchased rather is what we call the merchandise inventory. If we say merchandise inventory, goods held for resale by a merchandiser are called merchandise inventory and are reported as an asset on the balance sheet. This being said, a service company would not normally have merchandise inventory because in the first place, they are not selling merchandises or merchandise goods. And take note that under inventory systems, there are two types of ways in which inventory is managed. First, we have perpetual inventory system. And second, we have periodic inventory system. Now, what's the difference between the two? In perpetual inventory system, the merchandise inventory account and cost of goods sold account are updated immediately when transactions occur. So here, as a merchandise inventory is purchased, it is debited to the merchandise inventory account. So as inventory is sold to customers, then the cost of the inventory sold is removed from the merchandise inventory account and debited to the cost of goods sold account. So in other words, a perpetual system means that account balances are known on a real-time basis. And by the way, this chapter focuses on the perpetual system. On the other hand, if we say periodic inventory system, the purchase of merchandise inventory is debited to a temporary account called purchases. And at the end of the accounting period, inventory is counted, known as a physical count. And the merchandise inventory account is updated and cost of goods sold is calculated. So here, in a periodic inventory system, the real-time balances in merchandise inventory and cost of goods sold are not known, all right? And it should be noted as well that even in perpetual system, a physical count must be performed at the end of the accounting period to record differences between the actual inventory on hand and the account balance. So the entry to record this difference is discussed later in this chapter. And the periodic system is discussed in greater detail in the appendix to this chapter. All right, I think that's a good place to stop. And so for that matter, let us now move on to the second key area of our lesson, and that's going to be the purchase and payment of merchandise inventory applying the perpetual method. Now, as introduced in chapter 3, if you can recall, a company's operating cycle includes purchases on account or on credit, and is highlighted in figure 5.2. Now, as you can see in figure 5.2, it illustrates the purchase and payment portion of the operating cycle. Now, as you can notice, this is an example of one operating cycle. And if you may know, it started in inventory being purchased. So you buy or you purchase goods or merchandises. And after having purchased your inventory or goods, a liability is incurred. May it be because you purchase those goods or items on credit. That is why it is considered as an accounts payable to the part of the company. And since the company has a debt obligation to pay, then it is now time for them to make a payment. So next is cash payment to supplier is made, and then inventory sold to customer, and then accounts receivable result because the company received payments from their customers, and then cash is collected from customers, especially those customers who purchase on credit. All right, so this is one example of an operating cycle. Now, under recording and purchase of merchandise inventory applying perpetual method, take note that when merchandise inventory is purchased, the cost is recorded in a merchandise inventory general ledger account. So an account payable results when the merchandise inventory is acquired but will not be paid in cash until a later date. For example, recall the vehicle purchase on account by Excel for $3,000. Now, the journal entry and general ledger T account effects would be as follows. So as you can see there, in your general journal, you debited merchandise inventory, okay? So that's $3,000. And then you credited accounts payable. So that would be $3,000 as well. So this transaction is about to record the purchase of merchandise inventory on account. Now, since it was purchased on account or on credit, so that is why you have there another account that is involved in this type of transactions is accounts payable, and that is credited because the company itself, the Excel company, purchased the vehicle on account. So meaning to say, Excel has a debt obligation to pay. And in addition as well, in addition to the purchase of merchandising inventory, there are other activities that affect the merchandise inventory account. For instance, merchandise may occasionally be returned to a supplier or damaged in transit, or discounts may be earned for prompt cash payment. Now, these transactions result in the reduction of amounts due to the supplier and the cost of inventory. And this being said, the purchase of merchandise inventory may also involve the payment of transportation and handling costs. Now, these are all costs necessary to prepare inventory for sale, and all such costs are included in the merchandise inventory account. Now, these costs are discussed in the following section. Now, in the following section, we have here purchase returns and allowances, applying perpetual method. Now, in order for us to better understand purchase returns and allowances, let me give you an example. So, for example, assuming that the vehicle purchased by Axel turned out to be the wrong color. So instead of ordering red, okay, so the one sent to the customer is blue. So the supplier was contacted and agreed to reduce the price by $300 to $2,700. So the customer called Excel company, and instead of returning the vehicle, because initially the customer wanted a red car, and then the one that was delivered to him was a blue car. So instead of returning it to the company and the customer had an agreement that the vehicle should be kept or can be kept by the customer, but with a reduction in the price. So instead of the customer paying $3,000 for it, the customer has a discount of $300. So instead of paying $3,000, the customer would now be able to pay $2,700 instead. Now, this is an example of a purchase returns and allowances adjustment. Now, the amount of the allowance or reduction is recorded as a credit to the merchandise inventory account as follows. You can see on the general journal entry. Now, this is, take note that the cost of vehicle has been reduced to $2,700, right? And this is calculated by 3,000, which is the original price, minus the purchase returns and allowance of 300. So all in all, that's going to be 2,700, as has the amount owing to the supplier. Again, the perpetual inventory system records changes in the merchandise inventory account each time a relevant transaction occurs. On the other hand, we have purchase discount, still applying perpetual method. Now, if we say purchase discount, this affects the purchase price of merchandise if payment is made within a time period specified in the supplier's invoice. Now, in order for us to better understand what a purchase discount is, then let me give you an example. So, for example, if the terms on the $3,000 invoice for one vehicle received by Excel indicates 1/15 and 45. Now, what does it mean? This means that the $3,000 must be paid within 45 days, or N equals net. However, if cash payment is made by Excel within 15 days, then the purchase price will be reduced by 1%. So assuming the amount is paid within 15 days, the supplier's terms entitle Excel to deduct $27. That is $3,000 minus 300. So the total would be $2,700. So the payment to the supplier would be recorded as this one, okay? So you have here accounts payable being debited. So that's gonna be 2,700, and merchandise inventory credited, which is $27, and you have cash credited $2,673 to record payment on account within the discount period. So what happens here technically the customer got a discount of 1% because he made a payment within 15 days. So that is why you have their $27 discount. All right. The cost of the vehicle in Excel's inventory records is now 2,673. So that is calculated as $3,000 minus 300 minus 27. If cash payment is made after the discount period, so $2,700 of cash is paid, and the entry would be this one. So if in case the payment is made after the discount period, which is within 15 days, then this is how your general entry would look like. So you have their accounts payable debited $2,700 and cash credited $2,700. To record payment of account, no purchase discount applied. So you need to indicate that there was no purchase discount applied since the customer made a payment beyond the designated date, all right, which is within 15 days. Now, take note that trade discounts are similar to purchase discounts. Now, a supplier advertises a list price, which is the normal selling price of its goods to merchandisers. Therefore, in order for us to better understand what a trade discount is, then let me give you an example. So, assuming a supplier offers a 10% trade discount on purchases of 1,000 units or more, where the list price is $1 per unit. So if Beta Merchandiser Corporation buys 1,000 units on account, then the entry in Beta's records would be this one. Okay, so this is how your journal entry would look like. So as you can notice, your merchandise inventory is debited, amounting to $900, and your accounts payable is credited, amounting to $900. To record purchase on account and 10% trade discount, so that's $1,000 minus 10%. So you are now able to pay $900 instead. All right. So note that the net amount or list price less trade discount is being recorded. And under transportation, costs to transport goods from the supplier to the seller must also be considered when recording the cost of merchandise inventory. Now, this being said, the shipping terms on the invoice identify the point at which owner of the inventory transfers from the supplier to the purchaser. So when the terms are transportation, there are two types that we need to get acquainted with. First, we have FOB shipping point, and we also have FOB destination point. Now, what's the difference between the two then? If we say FOB shipping point, ownership transfers at the shipping point, so the purchaser is responsible for transportation cost. On the other hand, for FOB destination point, it indicates that ownership transfers at the destination point. So the seller is responsible for transportation costs. So FOB is the abbreviation for free on board. All right. Now, in order for us to better understand this, let me give you an example. So for example, assume that Excel's supplier sells with terms of FOB shipping point, indicating that transportation costs are Excel's responsibility. Now, if the cost of shipping is $125 and this amount was paid in cash to the truck driver at time of delivery, then the journal entry would look like this. So you would be debiting merchandise inventory amounting to $125, and you would be crediting cash because you let, this is an outflow, okay? So you let a certain amount out of your profit. So cash is being credited in this case, amounting to $125 to record shipping cost on inventory purchase. Now take note that the cost of the vehicle in Excel merchandise inventory account is now 2,798, right? This is calculated as $3,000, which is your original cost, minus $300, which is your allowance, right? Minus $27, which was your discount, plus $125 for the shipping cost. So it is important to note that Excel's transportation costs to deliver goods to customers are recorded as delivery expenses and do not affect the merchandise inventory account. All right. So the next section describes how the sale of merchandise is recorded as well as the related cost of items sold. Now that brings us to our third key area of our lesson, and that's going to be merchandise inventory, sales, and collection, applying the perpetual method. Now, in addition to purchase on account, a merchandising company's operating cycle includes the sale of merchandise inventory on account or on credit, as highlighted in figure 5.3. Now, as you can see in figure 5.3, it illustrates the sales and collection portion of the operating cycle. Now, take note that there are some slight recording differences when revenue is earned in a merchandising company. Now, under recording the sale of merchandise inventory applying perpetual method, take note that the sale of merchandise inventory is recorded with two entries. First, recording the sale by debiting cash or accounts receivable and crediting sales. And on the other hand, recording the cost of the sale by debiting cost of goods sold and crediting merchandise inventory. Now, in order for us to better understand this, let me give you an example. So, for example, assume the vehicle purchased by Excel is sold for $4,000 on account. Now, recall that the cost of this vehicle in the Excel merchandise inventory account is $2,798, right? Now, therefore, the entries to record the sale of merchandise inventory are as follows. So you have there, this is how your general journal or journal entries would look like. So as you can notice, originally, you have accounts receivable being debited amounting to $40,000, and you have also sales being credited $4,000 to record the sale of merchandise inventory on account. On the other hand, you have their cost of goods sold. This is the second method, okay? So you have their cost of goods sold being debited, amounting to $2,798. And you also have merchandise inventory being credited, amounting to $2,798 to record the cost of sales, all right? So again, like I said earlier, these are the two ways of recording the sale of merchandise inventory. As you can notice, the first entry records the sales revenue, and the second entry is required to reduce the merchandise inventory account and transfer the cost of inventory sold to the cost of goods sold account. And the second entry ensures that both merchandise inventory account and cost of goods sold account are up to date. All right. And under sales returns and allowances, when merchandise inventory that has been sold is returned to the merchandiser by the customer, then a sales return and allowances is recorded. So in order for us to better understand this, let me give you an example. So for example, assume that some damage occurs to the merchandise inventory sold by Excel while it is being delivered to the customer. Now, Excel gives the customer a sales allowance by agreeing to reduce the amount owing by $100. Now, your journal entry would look like this. So you will be debiting sales returns and allowances amounting to $100, since this is the amount given by the merchandiser to the customer. And you will be crediting accounts receivable amounting to $100, and to record allowance for damage to merchandise inventory during delivery. Now, take note that accounts receivable is credited because the original sale was made on account and has not yet been paid, right? Now, the amount owing to the customer is reduced to $3,900 instead of $4,000 because the customer, like I said earlier, was given a sales returns and allowances amounting to $100. Now, if the $3,900 had already been paid, then a credit would be made to cash and $100 refunded to the customer. And the sales returns and allowances account is a contra revenue account and is therefore deducted from the sales when preparing the income statement. So if goods are returned by a customer, a sales return occurs, and the related sales and cost of goods sold recorded on the income statement are reversed and the goods are returned to inventory. So another example we have, assume Max Corporation sells a plastic container for $3 that is purchased for $1. Now, the dual entry at the time of sale would be, so you need to debit accounts receivable amounting to $3, and sales is being credited amounting to $3 to record sale on credit. On the other hand, cost of goods sold is being debited amounting to $1, and merchandise inventory is being credited amounting to $1 to record the cost of sale. Now, take note that the use of a contra account to record sales returns and allowances permits the management to track the amount of returned and damaged items. All right. And on another topic, we have sales discount. Now, sales discount is another contra revenue account, and sales discount records reduction in the sales amounts when a customer pays within a certain time period. For example, assume Excel Car Corporation offers sales terms of 2/10 and 30. Now, this means that the amount owed must be paid by the customer within 30 days. So N equals net. However, if the customer chooses to pay within 10 days, a 2% discount may be deducted from the amount owing. Now, in order for us to better understand this, let me give you an example. So for example, consider the sale of the vehicle for $3,900, calculated as $4,000 less the $100 allowance for damage in the earlier example, right? Now, payment within 10 days entitles the customer to $78 discount, and that is calculated as $3,900 multiplied by 2%. So that's going to be $78 discount. Now, if payment is made within the discount period, then Excel receives $3,822 in cash. That is calculated as $3,900, which was supposed to be the original price or payment of the customer. However, the customer received a discount of 78, and therefore 3,900 deducted by $78. So that's gonna be $3,822 cash, and prepares the following entry. So this is how our journal entry would look like. So you debited cash amounting to $3,822, and you also debited sales discount, which is amounting to $78, and crediting accounts receivable amounting to $3,900 to record payment on account and sales discount applied. Now, this entry reduces the accounts receivable amount to zero, which is the desired result. Now, if payment is not made within the discount period, Then the customer pays the full amount owing of 3,900. So as was the case of sales returns and allowances, the balance in the sales discounts account is deducted from sales on the income statement to arrive at net sales. Now, merchandisers often report only the net sales amount on the income statement. Details from the sales returns and allowances and sales discounts are often omitted because they are immaterial in amount relative to total sales. However, as already stated, separate general ledger accounts for each sales returns and allowances and sales discounts are useful in helping the management identify potential problems that require investigation. All right, I think that's a good place to stop on our third key area. So let's now move on to our fourth key area, which is adjustments to merchandise inventory applying perpetual method. Now, in order for us to verify the actual amount of merchandise inventory on hand is consistent with the balance recorded in the accounting records, then a physical inventory count must be performed at the end of the accounting period. So when a physical count of inventory is conducted, the costs attached to these inventory items are totaled. Now, this total is compared to the merchandise inventory account balance in the general ledger. So any discrepancy is called shrinkage. Theft and deterioration of merchandise inventory are the most common causes of shrinkage. Again, I would like to reiterate, theft and deterioration of merchandise inventory are the most common causes of shrinkage. Now, in order for us to better understand this, let me show you a sample journal entry. So the adjusting entry to record shrinkage is this one. So this is how our journal entry or adjusting entry for shrinkage. So you have their cost of goods sold being debited and merchandise inventory being credited, and to adjust for shrinkage. And also under summary of merchandising transactions, as the preceding sections have illustrated, there are a number of entries which are unique to a merchandiser. And these are summarized. Assume all transactions were on account, meaning purchase on credit. So letter A, to record the purchase of merchandise inventory from a supplier. So in this case, this is how your general entry would look like. So merchandise inventory being debited and accounts payable being credited. And for letter B, to record purchase returns and allowances. So this is how your journal entry would look like. So your accounts payable being debited and merchandise inventory being credited. And letter C, to record purchase discount. So this is how our general entry would look like. So accounts payable being debited and merchandise inventory being credited. And letter D, to record shipping costs from supplier to merchandiser. So merchandise inventory being debited and accounts payable being credited. And letter E, to record sale of merchandise inventory and cost of the sale. Now, for the first one, in recording sale of merchandise inventory, what you do is you debit accounts receivable and you credit sales. On the other hand, for cost of the sale, so cost of goods sold is being debited and merchandise inventory is being credited. And letter F, to record sales returns restored to inventory. So there are two ways. So first, you debit sales returns and allowances, and then you credit accounts receivable, or merchandise inventory being debited and cost of goods sold being credited. And for letter G, to record sales returns and allowances where returns are not restored in inventory or to inventory rather. So you debit sales returns and allowances and you credit accounts receivable. Our condition is where returns are not restored to inventory. And for letter H, to record discounts. So you debit sales discounts, you debit cash, and then you credit accounts receivable. And finally, for letter I, to record adjustment for shrinkage at the end of the accounting period. So you debit cost of goods sold and then you credit merchandise inventory. So the effect of these transactions on each of merchandise inventory and cost of goods sold is depicted here. So this is how your summary would look like. So you have their merchandise inventory or MI in the left corner, and you have their cost of goods sold or COGS in the right corner. So under merchandise inventory, under debit, you have purchase of merchandise inventory, you have shipping costs, you have sales returns when restored to inventory. And under credit side, you have purchase returns and allowances, you have purchase discounts, you have sale of merchandise inventory, and you have shrinkage or adjustments and adjusted balance reported on the balance sheet. On the other hand, in my right corner, you have the cost of goods sold or COGS. And under debit side, you have cost of merchandise inventory sold and shrinkage adjustment. And on the credit side, you have cost of sales returns restored to inventory. And finally, the last key area of our lesson, that would be merchandising income statement. Now, take note that businesses are required to show expenses on the income statement based on either the nature or the function of the expense. So what is the difference between nature of an expense and function of an expense then? Well, if we say nature of an expense, it is determined by its basic characteristics or what it is. For example, when expenses are listed on the income statement as interest, depreciation, income tax, or wages, this identifies the nature of each expense. On the other hand, if we say function of an expense, it describes the grouping of expenses based on their purpose, so what they relate to. For example, an income statement that shows cost of goods sold, selling expenses, and general and administrative expenses has grouped expenses by their function. So when expenses are grouped by function, then additional information must be disclosed to show the nature of expenses within each group. What I mean about this is that the full disclosure principle is the generally accepted accounting principle or the GAAP that requires financial statements to report all relevant information about the operations and financial positions of the entity. So information that is relevant but not included in the body of the statement is provided in the notes to the financial statements. So a merchandising income statement can be prepared in different formats. So for this course, only one format will be introduced, which is the classified multiple step format. And this format is generally used for internal reporting because of the detail it includes. So this is an example of a classified multiple step format. All right. So this is an example of classified multiple step format of XYZ Incorporated income statement, month ended December 31st, 2015. Now, as you can see, notice that the classified multiple step income statement shows expenses by both function and nature, right? Now, the broad categories that show expenses by function include your operating expenses, as you can see in the presentation. You also have selling expenses and general administrative expenses. Now, with each category, the nature of expenses is disclosed, including sales salaries, advertising, depreciation, supplies, and insurance. And notice that the rent expense has been divided between two groupings because it applies to more than one category or function. Now, the normal operating activity for XYZ Incorporated is merchandising. Okay, so this is a merchandising type of business. So revenues and expenses that are not part of normal operating activities are listed under other revenues and expenses. So XYZ Incorporated shows rent revenue under other revenues and expenses because this type of revenue is not part of its merchandising operations. And dividend, interest earned, dividends earned, and gains on the sale of property, plant, and equipment are other examples of revenues not related to merchandising operations. So XYZ Incorporated deducts interest expense under other revenues and expenses. Interest expense does not result from operating activities, and therefore it is a financing activity because it is associated with the borrowing of money. And another example of a non-operating expense is losses on the sale of property, plant, and equipment. So income tax expense is a government requirement, so it is shown separately. And notice that income tax expense follows the subtotal income before tax. All right, I think that's a good place to stop. If you have questions, please let me know in the comment section below. And if you like this video, please don't forget to subscribe and hit the bell button for the latest updates. Thank you.